Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. There's just 30 minutes to go now until the closing bell, and stocks right here, they are mixed. Let's take a look at the popular averages. The Dow is up about 270 points. The broad gauge, your S&P 500, it's up about 0.1%. Meanwhile, your tech-heavy NASDAQ is down about 0.1%. Inez Ferre is here to break down all of the market moves. Inez, what are you seeing?
Josh, we're watching the Dow. As you just mentioned, the Dow is on pace for a record close. We'll see if it goes above 47,000 for its close or not. But nevertheless, right now you are looking at it on pace for a record. The NASDAQ slipping a bit, but then you've got the S&P 500 that's slightly higher. We do want to note that the 10-year Treasury yield, that is below the 4% mark. So we're watching that closely. And then also just taking a look under the hood at where we're at with equities. I just mentioned a little bit of a mixed market. The NASDAQ 100, you can see some of the laggards on here include Alphabet, Broadcom. You do see Amazon that's gaining and NVIDIA that's slipping just slightly. But just taking a look also on the Dow, take a look at Coca-Cola, up more than 3.5% following its quarterly results. You also have Salesforce that's also higher as well. So that's really driving the Dow higher. And then just taking a look at where we're at with crypto, we have been watching Bitcoin climbing higher around the 112,000 per token mark. And crypto bulls are looking at Bitcoin to see whether or not this recovery that we've seen over the last couple of days will follow through, and whether or not you're seeing a rotation that's out of gold and into Bitcoin. We will see, because gold is down more than 5%. That's been the talker of the day, putting that monster rally that it just had on halt, on pause. This is the worst daily decline for gold in about 12 years. You're also looking at silver futures, those also tumbling down more than 7%. It's worst day since 2021, Josh.
All right, thank you, Inez. Appreciate it. Well, the Dow hitting a record high as earnings drive the action on Wall Street today. My next guest says now is the time to be overweight value, not AI or tech. Joining me now is Matt Rowe, Man Group Managing Director of Solutions and Senior Portfolio Manager. Matt, it is good to see you. So let's start with the Dow hitting that record. Could be looking at its first close above 47,000. What do you make of that?
Well, what we're seeing is a lot of shifting of risk, not reduction of risk or increase in risk. And that's why in the intro, thanks for the shout out there, to focus on moving to value, which I think is partly what we're seeing today. I didn't cue that up for the piece, but I think people are moving away from more risky assets, things that have multiplicative return potential, and they're bringing money back towards things that are a little bit more stable, a little more value oriented. That's what I think is driving some of the outperformance today that we're seeing in the Dow. I mean, the market isn't made by one day move, so ask me in 2 months. But I think people are really looking to change the nature of the risk that they have, not reduce or increase it.
Do you see, Matt, I mean, listen, we have bulls on the show who say, listen, economy is resilient.
Yeah.
That's translating into healthy earnings growth. Oh, by the way, the Fed's cutting. Market's going to keep moving right higher into year end. Is that how you see it?
I think we are going to see interest rate cuts into year end. The market right now is pricing in pretty much a lock that we're going to get 25 basis points in October and another 25 basis points in December. Beyond that, it's a little bit less certain. I would say that part I do agree with. Does the market
need those cuts to move higher?
Yes. I think it's already pricing it in. I mean, I think we're in an environment now where the future benefit of information gets priced in right away. So as an example of that, one of the reasons why I think that the market is taking a lot of comfort in the recent early rounds of earnings is that you're not seeing catastrophic impact of tariffs on earnings. The reality is that it will take a while for these things to show up. So higher food costs, higher costs, kind of across the board. They don't show up right away, right? Like companies figure out a way to absorb them, to pass them on, various ways of dealing with it. And the reality is people and companies in the same way, they're not really sure what things are going to look like in a month, in 2 months, in 6 months. So we're kind of dealing with it as we go. So look, I think the optimism is not misplaced per se, but I think you have to be careful where you take risk. I mean, one of the things that we've seen as a narrative in the market is chasing the AI theme. Now, most people would be remiss if they didn't have some exposure to the multiplicative return potential of the AI narrative. But I do think that we're kind of in an environment where it's like the late 90s venture capital model. You could make 10 investments, 8 of them fail and go to zero, 1 of them breaks even, and 1 of them hits at 100-time return. You still have a very good portfolio return, even in that type of environment. I think people are acknowledging that it's not going to be amazing and have a multiplicative return benefit for everything under the sun, but you just don't really know where it's going to show up for sure yet.
How do you try then as an investor to screen for where it will show up?
I think it's really risky to make idiosyncratic choices on this one's going to win and that one's not. So I think that's why people are sort of painting with a broad brush and trying to maintain exposure to that theme across portfolios. But everybody's a little worried about how far it's pushed and what the actual flow-through benefit of using AI is. I mean, you could pretty much say, we're going to include AI in our customer interface no matter what you do, and your stock's probably going to go up.
Can I ask you, there was this, listen, U.S.-China trade tensions, it's more in focus again.
Yeah.
President Trump speaking today, man, I don't know if you caught this, said maybe this meeting with China Xi and South Korea next week, maybe it won't happen, he says. What are we supposed to do with that as investors, if anything?
Yeah, I mean, exactly to the previous point in our discussion there, people just don't know. You're not really sure what that means. So when the knee-jerk reaction from the administration is, okay, tariffs are back on and in a big way because of a reaction to the back and forth that occurred in the last couple of weeks, now there's going to be a discussion and then maybe there won't be, but he has a really good relationship by his own description with President Xi, and they'll probably get to a good deal, but maybe they won't talk. It's really impossible to sift through it. The one thing that I think the market is comfortable with is if you get to enough brinksmanship, people are assuming that he will pull back, that the administration will pull back and come back to something that's more in the middle or pulling it back entirely. I don't think the taco trade, as they describe it, I don't think that's a safe play at the moment. It's not.
He really doesn't like when you bring that up, Matt.
No,
I have to say that doesn't go over well.
I use the acronym, not the actual word.
A smart man. Matt, always great to see you.
Thank you,
sir. Well, OpenAI revealing a new product that is heating up the AI browser wars. Yahoo Finance's Dan Howley joins you now with the details. Dan, a browser battle.
Yeah, big browser showdown. This is the ChatGPT Atlas, and it is OpenAI's own web browser. And yeah, I mean, this is going right up against Google's Chrome. Chrome has around 72% of global market share when it comes to the web browser. I mean, I'm sure most people use it on the regular, unless they're using Safari on their iPhone. But even outside of that, people still download it. So this is OpenAI's stab at taking on that part of Google's market share in the browsing space. They also obviously have ChatGPT, which goes up against Google's own search. And so the big differentiator here is that ChatGPT is built directly into Atlas. You'll be able to do things like use natural voice search for old tabs that you may have closed or Google Docs that you've worked on in the browser, as well as just type your standard URLs for things like yahoofinance.com, all in the same box. You can also have something called an agent. So what this will allow you to do is have the web browser essentially do things like shop for everything that you need on your weekly grocery list via Instacart or book reservations for a restaurant. So it's one of these kind of new brands of browsers where they're putting all of the generative AI know-how into it so that you don't have to necessarily go in Chrome and then navigate to ChatGPT's website itself. You can just do it all from there. Google, they also have their own Gemini capabilities in the Chrome browser and the Google search. That's the AI mode or AI overviews. Perplexity has its own browser. Microsoft's Edge has built-in Copilot. So we're seeing more and more of this AI trickle in. But I do think that OpenAI itself poses this kind of almost existential threat to Google, not immediately, right? But there is that creeping fear.
Well, that's what I wanted to ask you. I wanted to ask you, like out there in Mountain View, California, Alphabet headquarters, I want you to, how worried do you think they are? How worried should they be?
I think, initially they were freaking out, right? Because once, when ChatGPT came out, they were kind of, just caught flat-footed like the rest of the industry, except for Microsoft. And since then, they've managed to catch up more and more with Gemini. There's almost like a kind of back and forth between all of the AI models, which is better, which is top of the heap. They all kind of trade positions all the time as new versions come out. So Google is okay there, but I think it's really that mind share, right? When you think of AI, you think of ChatGPT, you think of NVIDIA, right? Google, you think of search. And yes, they are making AI a big portion of search, right? They'll say that, however many millions of people use AI overviews. That's just there when you use a regular Google search. It's not like you're navigating to that on purpose. You have to be purposeful to use something like ChatGPT. So I think that that's probably where they're caught up. Is that Chrome is still the leading browser. People still use Google for standard search for the most part. But when you think about AI and you think about where these things going, it's ChatGPT.
Yep, Dan, thank you, my friend. Appreciate it. Coming up, shares of EOS Energy are jumping after making a slew of announcements. We're going to be talking to that company's CEO. Plus, Tesla reports its third quarter results tomorrow. We'll tell you what you should be watching for. EOS Energy Enterprises making AI moves as it looks to scale operations to meet growing market demand, driven in part by AI infrastructure. Company looking particularly at Pennsylvania, calling the state a national hub for energy, technology, and manufacturing innovation. Joining us now with more is EOS Energy Enterprises CEO Joe Mastrangelo. Joe, it is great to see you on the show. So you make these three big announcements, Joe. A lot of news today. I guess big picture, Joe, for investors who are listening, these partnerships, these expansions you've announced, Joe, add it up for us. What is it going to mean for your company, your business, your long-term growth?
Yeah, so Josh, when we announced today, well, let's start with the manufacturing expansion. It allows us to quadruple the size of our manufacturing capacity over time. It also allows us to do it in a more cost-effective, more efficient means. Then we announced two commercial agreements, one with Talon Energy, which is one of the largest independent power producers, a lot of their assets right here in Pennsylvania. I think when we looked at working with Talon and my discussions with their CEO, Mac McFarland, is we just felt that the EOS technology had a really good fit with what they're trying to do, both at their nuclear facilities, their former coal facilities, and their gas facilities. We've got a great technology that provides a lot of operating flexibility. And then we announced another order with M&8, which is a large renewables developer. And our technology, like what I always tell people, green or brown molecules and electrons, we don't discriminate against either one. And when you have excess supply and not enough demand, we can store them and bring them back on the grid when you need them.
Talk more about this news with Talon. It sounds like that's Joe, really focused on AI infrastructure demand. And I'm just curious, as you think about that market, how big is that market, Joe? 5 years out, 10 years out, how fast do you see it growing?
So, we look at our technology as it fits into the space as the fastest technology to be able to increase the power available for hyperscalers, for data centers, for AI. And I think when you think about the industry, right, I've been in the energy industry for over 35 years. This is our first demand increase that we've seen in the United States in the last 20 years. And I think what EOS, the technology, allows you to do is take assets that are already installed on the grid and make them a lot more efficient. Look, as far as like looking forward, the demand, what you see on demand is high. I don't really know. Like if I could forecast that, I guess I'd be doing something different than I'm doing today. But what I can tell you is, we have the capability to be able to bring reliable, safe power and a technology that's non-flammable, non-toxic, that could sit next to any asset that's going on the grid and pose no threat to that asset.
And Joe, why Pennsylvania? Why that state? And do you see this rolling out in the future? These kind of partnerships, other states, other regions?
Yeah, Josh, great question, right? So why Pennsylvania for us right now? Look, we came to Pennsylvania in 2019 when we brought our manufacturing back from China. We've built up a world-class workforce. And we view this as a way to expand on that workforce. Pennsylvania right now is at the epicenter hyperscalers and AI. So being in Pennsylvania is great. Like we came here because of the blue collar workforce, that heritage of building things in Pennsylvania. But as we've become part of the fabric of the community here, there's also a great university community in the area that we're in. So we are able to scale into not only growing manufacturing, but also bringing universities like Carnegie Mellon University, University of Pittsburgh, to bring talent in to help us continue to advance our business. The way we designed the business, Josh, your other part of your question is, we designed our factories so that we can co-locate them where demand is. We don't need, it's a very simple manufacturing process. We basically need around 400,000 square feet, and we can put an 8 gigawatt hour factory. It reduces the complexity of our logistics and allows us to really create jobs where the demand is for power.
And so to be clear then, Joe, you are making your products here in the United States. You don't have to navigate that tariff dynamic?
No, that's right, Josh. So we brought manufacturing back from China in 2019. We have a supply chain that's 91% U.S. supply. We've got a path for our last two raw materials that go into the product to bring that to the U.S. We've had some great partners. When you hear these stories of we can't build things in America, EOS, it proves that theory wrong. Like we can do it. There's a lot of companies that have a lot of capability that you can bring to bear to grow your supply chain. And we're not navigating that tariff problem. We have a solution that meets the FAOC security requirements, and really are proud of the fact that this is a technology invented in the U.S., built on U.S. equipment, made with U.S. material, using U.S. hands.
Joe, great to have you on the show today. Thanks for your time. Appreciate it.
Thanks, Josh. Thank you. Talk soon.
Tesla heading into its third quarter earnings report on Wednesday after a solid quarter of car sales, and with even bigger questions around demand, leadership, and its AI ambitions. For more, we're bringing now Stephen Gengaro, NextGen Transport analyst at Stifel. Stephen, always good to see you. So Tesla's Q3 deliveries beat. It sounds like, Stephen, though, you're then expecting a possible lull in Q4. Walk me through that. I'm curious what you think EV demand looks like in the quarters ahead, Stephen, as in this kind of post-EV tax credit world.
Thanks, and good to see you, Josh. So I think what I'd start with is, the third quarter, I think, clearly benefited from some pull forward of demand from the EV tax credits going away on September 30th. So that clearly helped sales, and we saw it in the Tesla numbers, and we'll get more color here tomorrow night. I think as we go forward here, in the U.S. market, we would not be surprised to see a bit of a downtick here over the next couple quarters. Part of that, I think, is related to the pull forward of demand that I mentioned. I think part of it is related to the fact that the cars are just going to be a bit more expensive near term without the EV tax credits. If you looked at some of the deals out there, not only from Tesla, but other EV manufacturers in the U.S., there were some pretty compelling buying opportunities into the end of September. And I do think that leads to a couple quarters here where you get some softness in EV sales.
What about, Stephen, those new lower priced Model 3 and Y models? What do you see that meaning what does that mean for growth and for margins looking ahead?
Yeah, I think, and you bring up a good point, Josh, on the margin side, right? As we look into the fourth quarter and the first quarter, the lack of credits and Tesla pushing lower priced vehicles to maybe offset things on the volume front, probably do create a margin headwind in the near term. I think when you look at Tesla's business model over time, I think Elon wants as many Teslas in the market as he can, not only people buying the cars, because it sort of underpins the potential growth in the full self-driving side, and then ultimately the robotaxi business over time. So I think there's probably some margin headwinds in the next couple of quarters. I do think those lower price cars help sort of lessen the blow, on volumes over time. But I think in the short term, it will have an impact on volumes.
What about that robotaxi business, Stephen? I'm curious. What are you watching for and listening for there?
Yeah, it's interesting. It's clearly controversial. It's something we have a lot of discussions about. The launch, I think, has gone well in Austin thus far, and I'll stress though that this is an early stage product, right? Rides are still limited. Customers can use the app and kind of get in line but there's a human safety monitor at all times. So this is still early stage, right? And there's still some hurdles to get over, both in Austin and some of the other markets like Nevada and Arizona that they're looking at. What we look for really on the call tomorrow, and clearly Elon tends to be bullish on the stuff, but we do look for incremental data points on how things are going. They're ultra focused, obviously, on safety, because any incident would be magnified 100-fold. But really progress in Austin, progress on expansion, and then just more details, honestly, on how version 14 of FSD is going and how that rollout evolves and how sort of that impacts the safety and traction that this ultimately gets. Those are probably the biggest factors we're looking at on the call tomorrow.
Stephen, you look at this stock, I mean, we're up about 100% over the past 2 months, but you must think, valuation is still attractive here, Stephen.
Yeah, we do. And it's something we get pushback on from some of the bears, and it really centers around, if you're buying Tesla because they sell cars, you shouldn't buy Tesla right now, right? You're buying it for the very large opportunity on the FSD and the robotaxi side, and then ultimately the potential growth in Optimus. Our valuation is really centered around FSD and robotaxi, and we don't actually have a lot in Optimus in our $483 target price yet. But clearly others believe that Optimus could be the biggest thing at the company. So that's how we look at value right now.
And Stephen, I got to ask you about Musk's pay package, because that's been making headlines. You saw Glass Lewis urging shareholders to reject it. ISS weighed in, urging shareholders to reject it. I spoke this week with Barron's Al Root. Stephen, he covers the company closely, reports on it. I asked Al, what do you think, as a guy who covers the name? He says, listen, this is going to pass. He says, Musk wants it. Musk is going to get it. I'm curious what you think.
Yeah, and I think, Josh, we may actually talked about this a little while back. I mean, Elon's critical to the company. I think his focus on Tesla is obviously very important to the success of the company. I think it passes. I think it's an enormous amount of money, clearly. But if you look at the benchmarks to reach that compensation package, some of the benchmarks, particularly on the EBITDA targets over time, they're off the charts high, right? So if he gets the company to that level, I think most shareholders will be pretty happy about it.
Stephen, always great to see and to have you on the show. Thank you, sir.
Thank you, Josh.
Well, we are wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime. That's the closing bell on Wall Street, and now it's Market Domination Overtime. We're giving you full coverage of all the moves to get you up to speed on the action from today's trade. Yahoo Finance's Jared Blickery joining us now with the latest market action. Jared.
Thank you, Josh. We're going to start with the Dow, as I usually do, but also because that is a record high, the first since early October. And let's take a look at the intraday price action. And you can see we catapulted to the record intraday high early on and just kind of drifted down. Nevertheless, closed the day with about 218 points to the upside, or about 0.5%. Meanwhile, the NASDAQ, tech heavy as we like to say, that closed just underwater, about 8 basis points down. Not a whole lot, but a very different chart from the Dow. And the S&P 500, look at that, barely closing green. Not even 1 point to the upside, 0.17 points. But investors will count that as a win nevertheless. Want to point out too, one thing I've been noticing is the Dow has been highly correlated with the S&P 500 equal weight. That's where every stock gets one vote in the S&P instead of being market cap weighted, where some of the largest stocks, they have the biggest weight. So nevertheless, S&P 500 equal weight was up 0.5% today, while the S&P 500 barely green. And let's check out the small caps as well, because there are divisions within the small cap universe. Russell 2000 down about 0.5%, and that includes unprecedented unprofitable stocks. But if we take a look at the S&P 600, which is also a small cap index, but does not allow unprofitable stocks in, that closed in the green. So there is a slight bias towards quality today, and also I would say breadth, and that's kind of indicative of that equal weighted S&P 500 index doing well. Now let's take a look at the 10-year T-note yield, see what bonds did. 10-year note down 2 basis points, now below 4%, 3.96%. It closed under 4% yesterday and also last week, but that is something that we want to watch here. 30-year T-bond yield down 3 basis points to 4.55%. And let's get into some heat maps and just start with the sector action. Consumer discretionary landed on top thanks to Amazon. That's up over 1%. Then we got industrials, communication services, healthcare tech, all of those outperforming the S&P 500 on the top row. Utilities, the biggest dive today, that was down 1%. And let's take a peek inside the NASDAQ 100. A lot of those mega caps on top underwater. Google, Alphabet down over 2%, but Amazon up 2.5%. I said that was kind of carrying the consumer discretionary sector. And let's take a look at the Dow Industrials as well, where we see Salesforce up 3.5%. Software did very well today, chips not so much, but we also saw a nice move from Coca-Cola, that was up 4%, and 3M up 7%. We're seeing a lot of those industrial earnings starting to roll in. I'm going to finish here with the Dow Transports, and we see a lot of red in some of the bigger stocks, but I sort by performance here. You can see a pretty nice mix of airlines being up today with some of the traditional transports. UPS up over 1%, so is FedEx, and then looks like American Airlines, the best performing airlines of the day, up about 1.5%. Josh?
Thank you, Jared. Now turning to Netflix, as its third quarter results are just hitting the wire, and you can see the stock is down a quick 5% here in the after hours. Q3 EPS, let's start there, 587. She was at 694, so that's a miss on the bottom. Q3 revenue, top line, comes in at $11.51 billion. Street was closer to $11.52 billion. Let's turn ahead. What do they see in Q4? They're saying Q4 EPS, they're looking for 545. The estimate was 542. And for Q4 revenue, they're saying they look for 11.96 billion. The street was at 11.9 billion. And now turning ahead, full year revenue, they are calling for 45.1 billion. They had seen between 44.8 to 45.2 billion. So the stock is down a quick 7% here in the after hours. You know, it had a run into this print. Remember, we were up about 40% year to date heading into this report. Some other big questions I know analysts are going to have. More color and commentary you're going to want on viewer engagement. That's a metric, remember, we still get. You had that smash hit, K-pop Demon Hunters, global sensation, trends and themes in the advertising business, how the company's thinking through that mega AI trade and trend. And of course, we did hear today a report that Netflix possibly interested in Warner Brothers Discovery, or at least parts of that company, so you can be sure that is going to come up on the call as well. But we're down a quick 6% here, at least initially, in the after hours. Well, talk of an AI bubble is growing louder on Wall Street as the tech-fueled rally continues to power the market. Our next guest says it's frothy, but we haven't reached .com territory, at least not yet. Joining me now is Ayoko Yoshiaka, Portfolio Consulting Director at Wealth Enhancement. That firm is $117 billion in client assets. It is great to see you, especially here on set. And your timing, impeccable, because Netflix just crosses. We got the results. You own Netflix. I'm putting you on the spot here. I know they just crossed, but what do you think broadly?
Sure. So the miss is never something that we'd like to see, but the guidance wasn't too bad. And again, we go back to owning quality growth companies, and we believe that the company continues to generate strong free cash flow. They've gone from generating $1.6 billion in free cash flow to about $9 billion, expected to grow to about $11 to $12 billion next year. And we continue to think that that's the trajectory that they're on. We know there's going to be bumps in the road here, but we like the content. We like the fact that they've been more disciplined on expense. And so we are long-term holders of Netflix.
Let me ask you, you got that report today, which says Netflix, among others, might be interested in Warner Brothers Discovery, or at least part of that business. Who you can be sure they're going to get questions about this on the call. You own Netflix. Granted, I don't know the price, but as you think strategically, would you be happy with if you saw that headline drop?
You know, I think content is king. You've seen it with the Demon Hunters and everything like that. The success.
Demon Hunters, huge in the Lipton household with a 6-year-old.
Absolutely.
Fanatical fan.
Oh,
Yeah.
I have a daughter as well, teenager, she loves it.
Yeah.
So, you know, I think it's something that as long as the content is there, as long as it's, the demand is there for that, and I think Warner Brothers Discovery has some of that. It's going to have to get pruned down a little bit probably, and if Netflix can do that and really focus in on the content that's in demand, we'd like to see that going forward.
Let me ask you about another name you own, which is Apple, which has had a run. We woke up to a bunch of positive headlines there. Which seemed to indicate maybe a stronger iPhone cycle than some had thought would happen. What do you think?
You know, it's what we've all been waiting for quite some time. I think last year when the 16 came out, we were all waiting for that refresh cycle to really, you know, bolster Apple stock going forward. I think we're starting to see that with the 17, or at least early indications are that demand is very high, and investors really, consumers really want that phone. So I think that's what the stock has needed for quite some time.
So I got to ask you, because you're involved in these big tech names, that big debate you hear right now, AI boom, AI bust. I mean, you had some very notable high-profile investors. They were kind of throwing yellow flags. Someone is saying they're hearing echoes of the .com era. I mean, what do you think?
I started my career in the late 90s and lived through the .com bubble bursting, and I will say that there are signs that there's a lot of froth. You know, there's some smaller cap names out there that are trading at hundreds times their earnings multiples and things like that. But I think when you look at some of the mega cap tech stocks that have led the charge in the S&P 500, they're still closer to being more reasonably priced. They still generate strong free cash flow, and we think that that's going to continue. You also don't have the 1/1/2000 sort of deadline that you had back in the 90s and like early 2000, in which everybody had to purchase all that equipment or else things were going to go haywire. We have a little bit more of a runway for AI, I think, and I think we're still in the early innings of building out that infrastructure.
As these tech earnings, Ayoko, as they get reported, and you're going to be listening to these conference calls, I'm just curious, as an investor, are there certain metrics or certain data points that you're going to be studying to see, to try to judge whether all this just historic AI investment and spend is paying off?
I think it gets cloudier and cloudier as the spend is now more in private markets and private companies than it is in the public side. You're seeing all these announcements with OpenAI and how that circularity is going around with NVIDIA and AMD and Oracle and all of that investments. I think the CapEx from the hyperscalers are really going to be the metric that we all continue to watch to determine whether or not there's continued spend for AI.
Ayoko, it was great to have you here, especially on set. Thank you.
Thank you so much.
Well, Amazon Web Services back online. It's after a major outage that knocked out parts of the internet for millions of users worldwide. For more, we're bringing in Yahoo Finance tech editor, the one and only Dan Howley.
Heavy hitter, heavy hitter. Yeah, Josh, I mean, this is something that started with the domain name system. Basically, you can think about this as the phone book for the internet, where you type in a URL like yahoofinance.com, and the DNS basically translates that into an IP address for the actual website, you know, whatever web page you're trying to get to. It does that. It had issues there, then they had problems in their own database, and it just kind of cascaded over time. And so we had, you know, people offline. Some people couldn't do their schoolwork. I'm sure, you know, they were happy with that, those kids. Some people couldn't talk to their bosses. You know, different messaging services like Slack were offline. Sure, those people were pretty happy. And some people just got the day off more generally. But on a serious note, you know, this is an issue that impacted government agencies over in the UK. There's companies and organizations all around the world that rely on Amazon's web services being up 24/7. And, you know, we run into these issues every once in a while. In 2023, there was an outage for AWS, same location in its East Coast 1 facility, that data center outside of Virginia. We had companies go offline then. Same here. It is few and far between, you know, one day every 2 years, 2 days every 2 years. It's not awful, but it does point to one of the issues with having these huge cloud players, the Amazons, the Microsofts, the Googles, they're the largest in the world, that it does create for in instances like this, a more fragile ecosystem for staying online. And so, when you are so reliant on systems such as these and they go offline, or there's only 3 of them, it does raise questions of, should more companies be investing more in kind of a secondary cloud offering? And to their credit, a lot of companies do that. It's also worth pointing out, not every company has a cloud service yet, or we talk about AI now as if the cloud is, that's yesterday's news. But the reality is, thousands of companies around the world, if not more, still are not in the cloud or don't use cloud services. Yeah, they're all on-prem, and so they still have to get up there if they want. And so there's still room for expansion as far as that, and as far as companies go when it comes to maybe have a backup, a secondary service that you can lean on. But I mean, this is just kind of a wake-up call for, I think, a lot of people. Again, one that's come before. Doesn't seem to bother Wall Street, though. Amazon shares were up 2.5% today.
All right.
Yeah, I mean.
Double dose of Dan Howley in the show today. Always welcome. Thank you, sir. Coming up, we're going to take a look at some of the day's top trending tickers, plus Netflix shares trading lower here. It's after posting its third quarter results. We'll get an analyst take after the break. Stick with us. Now time for some of today's trending tickers. Yahoo Finance's Brooke DePalma. Join me now for a look. Talk some Six Flags, Walmart, Warner Brothers Discovery. Let's start off though with Six Flags. This one is interesting, Brooke. All right, so Travis Kelce reportedly teaming up with an activist investor that is pushing for big changes at Six Flags. Travis Kelce.
Yes.
Walk me through this headline. What is going on?
So the first thing, look at ticker symbol FUN. That's Six Flags ticker symbol there. It's up more than 17%. This was just announced about a half hour ago, and right before the market closed, we did see that run up in share price. It's $25 the stock now, and what we know from here is that Travis Kelce is part of an investment group or an activist investor group by Jana Partners. They took about a $200 million or a 9% stake in Six Flags this afternoon. That was based upon a release that that Jana Partners had put out this afternoon. Now, keep in mind, the reason why Travis Kelce is part of this activist investor, this initial stake, is because of the fact that Travis Kelce is a supporter of a particular amusement park that he went to growing up. It's called Cedar Point. It's based in Ohio. On his podcast, New Heights, he said that he goes to this amusement park once or twice a year growing up. And so in the release, he said that the chance to help make Six Flags special for the next generation is one that I couldn't pass up. And to quote Taylor Swift there, anything this man touches turns into happiness, fun, and magic. And we're seeing that play out this afternoon with Six Flags seeing this major run up.
What a move in that stock. All right, now turning to Walmart, the retailer reportedly pausing job offers to candidates needing H-1B visas. So this one, Brooke, all right, so Walmart has paused offers to candidates requiring H-1B visas. Now this is per Bloomberg, citing sources. It sounds like it primarily impacts corporate employees. Of course, the Trump administration, I think it was last month, imposed this $100,000 fee for new H-1B applications, but walk us through it.
Yeah, so we did reach out to Walmart and we did get a statement from them. Particularly said that Walmart is committed to hiring and investing in the best talent to serve our customers while remaining thoughtful about our H-1B hiring approach. So keep that in mind, but also keep in mind that Walmart is one of the top 10 companies in the nation that employs people who have these H-1B visas. But Walmart employs 1.6 million associates here in the U.S. Associates, what they call their employees, and they are nowhere compared to the amount of H-1B visa holders that companies like Amazon, like Tata Consultancy Services have, Meta, Microsoft. Those are some of the biggest holders of these H-1B visa holders. Also, Apple, Google, JP Morgan, Deloitte. Those are companies that have similar, but if not more, of these sort of employees. And so right now, Walmart's sort of assessing where this goes. That $100,000 fee that was announced in late September, of course, a pretty significant amount, but it definitely speaks volumes to just how exactly companies are going to go about this. As I said before, Walmart, the biggest retailer, the biggest employer, rather, in the U.S.
All right, finally, lastly, Warner Brothers Discovery. announcing a price hikes for HBO Max subscriptions. So this one, so raising prices, it looks like across all HBO Max subscription tiers, Brooke. Second price hike in less than 2 years, I think. Our own Alec now noting, just kind of really is broadly underscoring the push here, boost profitability across the streaming division.
Yeah, I actually got an email this afternoon from my HBO Max subscription saying that prices are going to increase. So I'm sure many consumers are getting similar emails right now. For basic with ads, it's going to increase by about $1 per month, yearly $10. Standard, also the premium, is going to increase as well. And this is just really the latest, as Ali pointed out, to note a push to push profitability, to boost profitability here. But also this comes on the tail end that right now Warner Brothers Discovery is considering a breakup option. We also heard that potentially, others are looking, like Netflix and Comcast are potential bidders here. And so we did see the stock see a bit of a run up, about 11% at the market close today, with all this latest news that was announced, both these pricing changes and then also the fact that they reportedly have received multiple bid offers from different players here.
All right, thank you, Brooke. Appreciate it. Well, Netflix out with its third quarter results, the streaming giant missing earnings estimates, but providing better than expected revenue guidance. For more on the quarter and the streaming landscape, let's get to Bloomberg Intelligence senior media analyst. That would be Geetha Ranganathan. Geetha, it is good to see you. So let's get right to these results. Geetha, the stock was up about 40% year to date heading into the print. Down in the after hours here. It sounds like Netflix, Geetha, is calling out this tax dispute with Brazil. They're saying that's what really sort of impacted the quarter here and the bottom line. But walk us through it. What do you see in the report?
Yeah, I think that's the first thing that, people kind of really looked at in terms of the operating margin and why they missed. I think investors were really looking for management to actually increase their operating margin guidance from 30% for the full year 2025 to a little bit more, maybe 31, 32%. They've actually now taken that down. And it looks like a lot of that can be attributed to the 3Q operating margin miss. So definitely somewhat underwhelming, just because we know that both third quarter and fourth quarter is supposed to be one of their best content slates ever. We've seen some very, very strong and encouraging metrics when it comes to engagement. You had the breakout hit with K-pop Demon Hunters, so all of that was kind of really feeding into, I think, this investor frenzy for better results. But, obviously the tax dispute was something that nobody could have foreseen.
They are, it sounds like, touting, Geetha, what they're calling record subscriber engagement. What are the trends and themes there? What are your questions around that metric?
Yeah, so that's exactly what they've been telling us all through. So the first half, and they already reported metrics in terms of, overall viewing hours, overall engagement. That was somewhat muted, I would say, from the first half of this year when you compare to last year. But then you look at, if we've just run some internal numbers as well, you look at the third quarter engagement metrics, really, really strong. And that's exactly what they're referring to in their investor newsletter. We've seen something like a 20 to 22% surge in engagement. And a lot of that just from all of those big monster titles. I mean, you have 3 of their most watched ever series just debuting in the third quarter. You have, K-pop Demon Hunters, which we just spoke about, biggest movie of all time, which came up in the third quarter. And then, of course, you had Squid Game season 3, as well as Wednesday season 2. Again, some of their most watched series ever. So all of that really driving very, very good engagement. And remember, engagement is the way that we are going to kind of evaluate this company going forward, because content drives engagement, drives monetization. And that's really where Netflix's pricing power kind of is anchored.
Geetha, I feel like I got to ask you, I'm sure you saw the report today suggest that maybe Netflix is one of those parties that could be interested in Warner Brothers Discovery, Geetha, or at least parts of Warner Brothers Discovery. What do you make of that? If you saw that Netflix really made a move there, would that be the smart move strategically?
Strategically, yes, it does make sense. They do have some very, very compelling, IP that would, help them with subscriber trends, that would help them lower churn, increase engagement. We just spoke about engagement. So all of that, yes, it makes sense. But traditionally and historically, when you've kind of seen Netflix's strategy over these past so many years, they've spent about $1 or $1.5 billion totally on M&A. So really, they've been very, very shy. There just hasn't been that appetite, and investors have kind of liked that build versus buy strategy. So I don't think anybody was really expecting Netflix to kind of come out swinging. Having said that, though, this is a once in a generational opportunity. Warner Brothers is a great studio. There's a great studio lot there, and there could be a whole lot of synergies that Netflix can achieve with the combination. So again, it's a little bit of a wait and watch, but I don't think it's a make or break for Netflix.
Geetha, let me ask you a bigger question, longer term. This question of sort of AI content creation, Geetha. OpenAI working with Vertigo Films, first feature-length film premiering next year. What does the mega AI trend and theme, Geetha, mean for Netflix in the quarters and years ahead? I mean, is it a tailwind? Is it a headwind? Is it potentially both?
Yeah, it is potentially both, but I think in the near term, it's actually going to end up being more of a tailwind for Netflix. They're already using AI pretty effectively. They've used it in their user interface for better personalization, better rankings and recommendations. Remember also when it comes to content production itself, Netflix is already using AI to create better visual effects, de-aging, for instance. So better content, faster content, right? They can make content much, much quicker now, kind of using the text to video prompts. And also cheaper content. So, we just ran some numbers and we said that using AI across the board can help trim content costs by at least 5 to 10%. That's a sizable amount of savings. We know that Netflix is spending something like about $18 billion. So you're looking like something, like about $1.5 to $2 billion in cost savings over time, which is pretty substantial.
Geetha, always great to see and to have you on the show. Thank you.
Thank you.
Well, that'll do it for Market Domination Overtime. Be sure to come back tomorrow for all of your coverage leading up to and after the closing bell.